Well, hello and welcome to the SBDC introductory video on financing for your business. I'm your moderator, Scott Fidel with Washington State University Extension. Now, if you haven't already done so, you can download a document from the SBDC website that covers the material we'll be discussing in this program. With me in studio to discuss today's topic, we have two certified business advisors from the Washington Small Business Development Center Network, so let's meet them. First, we have Rick Thorpe, who operates out of the Spokane office, and opposite me at the table is Tracy Stark, who's located in Mount Vernon. Thanks for being with us today. The panelists are going to be providing an overview of bank financing, including terminology you'll be seeing when you start applying for a loan, a discussion on the loan criteria, and a look at what the lender will be expecting from you. To get our discussion going, we'll start with some short definitions of terms to set the stage. So Tracy, how about starting us off with explaining to our business owners a few of the critical debt terms that lenders will likely be using in their discussion?
Well, our focus today is on debt financing, and this is money that you borrow from someone else to help with the operations of your business. And debt financing can come in different forms, such as a loan from, say, a family or a friend. But for purposes of today's discussion, we're focusing on more traditional debt financing, which is a business loan through a bank. So debt financing can be broken down into two categories: long-term debt and short-term debt. And long-term debt is paid back in over a year or more than 1 year. It's typically used to purchase things such as equipment, machinery, buildings, property, etc., long-term assets. Short-term debt is debt that's paid back in less than 1 year, and this is typically used for the day-to-day operations of your business. So things such as purchasing inventory and supplies and paying your employees. A line of credit is a good example of a tool that a business owner might use to help with short-term debt. And one principle that's important to keep in mind is that when you're looking into debt financing, you should make sure that you're matching the repayment of your loan with the useful life of the asset. So if you're purchasing a long-term asset, you want to make sure to pursue long-term financing for that.
Good. Thank you, Tracy. So we've got the terminology out on the table here. Now let's talk about the debt financing process from both sides of the equation, the borrower and the lender. So Rick, I'm going to turn to you now to help us with that. What are the two different approaches from these two different perspectives?
Well, first of all, both the borrower and the bank or financer have the same goal in mind. They really want to put a loan together. The borrower, who is the business or the person who owns the business, what they're looking at is they need to know how much money they need to borrow and what specifically they're going to use it for, how long they're going to need it, how much debt can they afford to take on. But from the lender or loan officer's point of view, they want to know, is the business and the person a good risk? Does their loan or their industry fit into their portfolio right then? Each banks have different portfolios at different times. And can the business actually pay back the money?
Okay, good. And I can certainly see where both the borrower and the lender want the loan to go through. That's what the banks are in the business of doing, and obviously the business owner is looking for some capital to help with his business. But as we mentioned, they're each approaching this from a different reference point. So here, probably would be helpful to our viewers if we discuss the criteria that a loan officer would use to answer really the basic question of, are you a good risk? So Tracy, how about helping us out with that?
In evaluating a loan, the lender typically uses some form of the 5 C's of credit. And those 5 C's are made up of capacity to repay, capital or equity, collateral, conditions, and character. And we'll go into each one of these in more detail so the borrower has an idea of what the lender is specifically looking for. Capacity to repay is often one of the most critical of these factors because the lender needs to know that the borrower can repay the loan. You've heard us say before that cash is king, and the lender would expect the borrower to provide some sort of proof typically through a cash flow forecast that indicates how much cash is available and that they have enough to pay back the loan. They'll also be looking at the payment history and credit and how the borrower has managed credit in the past. Capital or equity is the amount of personal investment that the business owner has put into their business. The bank doesn't want to take on all of the risk themselves, so they will expect the borrower to put a fair amount of their own resources at risk. The lender will oftentimes require anywhere between 10 and 30% investment into the business. Collateral is an additional form of security that the borrower provides to the lender. This oftentimes comes in the form of machinery and equipment or a building that the business owns, but sometimes it's expected that the owner pledge personal assets as well, which could be a personal home. This becomes a secondary repayment device if the borrower can't repay the loan, and oftentimes there's a personal guarantee that's also required. Okay,
as we talked about. Rick, how about bringing us in with the other two that are going to be used in that analysis of the loan package by a lender?
Sure. Money, what's it really going to be used for? Is it going to be used for working capital, equipment, inventory, or what? That's very important. Industry and local economic conditions for that industry, again, is very important, and that's going to be looked at. One of the most important when I work with banks is the general impression that the business owner makes on the banker or ourselves. We talk back and forth, and that's very important. Their educational history, and I think more important, their experience in the industry and management experience, the quality of the references, and the employee's background in that history, in that industry, and the experience they've had in it.
So that covers the 5 C's. Rick, is there anything else that comes to mind that a loan officer might use in making that final decision about whether to grant that loan or not?
Yes, there is. We work closely with the loan officers, and they'll often send people over to us to help them learn how to read their financials. They need to understand their financials and every number that is on those financials, and explain how they came up with those numbers in the case of forecasts. That's very important. From the balance sheet, the critical ratios, from the cash flow, making sure that it always has a positive position where the loans are paid back, all the bills are met, and it still has a positive cash flow. And they need to be able to explain all those forecasts from the assumptions that they were making when they made the forecasts on each one of them. You can review our video about these statements, but in brief, they include the following information. Income statement is the sales forecast, cost of goods, and expenses. They must be able to explain the forecast in a reasonable way. Balance sheet that shows strong ratios compared to the industry for quick, current, and debt to equity. Cash flow forecasts by month for 1 year shows ability to meet obligations and repay the loan.
I think that about covers it, seems like. Again, I want to thank our 2 guests from the Washington Small Business Development Center Network, Tracy Stark and Rick Thorpe, for taking the time to help the small business individuals watching this video better understand the basics of getting a loan. And I want to again encourage everyone watching to go back to the SBDC website to get access to information on contacting your nearest SBDC certified business advisor. And be sure to take advantage of the other training videos we have online at this site.